The area I work on is actually how economies become wealthy. My key area in economics is the theory of the firm, the innovative firm. And from that perspective, I should say, I start seeing what happens when business enterprises, which I argue are at the core of the economy, stop being innovative and stop investing in the labor force. And some people who have the power to do so are able to just take money for themselves that actually belongs to other people. That's basically what I've been working on. The key issue, I think, for everybody is how does an economy create sustainable jobs, jobs that pay people a decent wage over a long period of time. People don't need a high wage for a year or two. They need it for 30 or 40 years, and they need to have enough left over after that to support themselves in retirement, often for more and more years, as if they can stay well. And we did have a period in the United States, post-World War II, when basically large corporations, or any corporation of any size, once you got a job with that company, you probably had that job for a career, or you could have that expectation, and the company had that expectation that it would keep you employed for a year, for a career. The clearest manifestation of that was, well, one, you would get promoted over time, and you would get a defined benefit pension at the end, which would be based on years of service. That is what created a middle class in the United States. And that middle class in the 40s, 50s, 60s, into the 70s was mostly white. At the blue-collar level, it was high school educated. Increasingly at the white-collar level, it was college educated. In the 60s and 70s, those good jobs, those career, I would call them career with one company jobs, started opening up to women and to minorities, particularly blacks, as a result both of affirmative action, Civil Rights Act of 1984, Equal Employment Opportunity Commission, and strong demand for jobs. And the expectation right into the 70s, even into the 1980s, was that when you got a job with General Motors or General Electric, it was a job for life. And that all changed. And when that changed, there were three phases in which I see this transformation of employment relations going through, what I call rationalization, marketization, and globalization. Rationalization was basically aimed at blue-collar workers and just say we can't compete with the type of blue-collar workers we have, and we need to figure out either how to complete or close down the plants. And the main impetus to that was Japanese competition in the late 70s, early 80s, which at first people thought, well, they work long hours, they have low wages. But what we discovered, and what people discovered particularly in the early 1980s, as they started to look, was that the Japanese actually were much more productive than the Americans. And that was largely because they put skills on the shop floor. The second thing, which I call marketization, the transformation of employment relations, really kicked in a large way from the beginning of the 1990s. And I point to IBM, which was the iconic company for giving people a career with one company. They said that they did that. They had bragged going into the 1990s that they had never laid off anybody involuntarily since 1921. But between 1990 and 1994, they laid off 150,000 people net, starting from about 374,000. And this notion of a career with one company, lifelong employment, they called it, was gone. And the impetus to that was the rise of what I call the new economy business model, the Silicon Valley business model, where companies like Intel, Microsoft, Cisco, as they came along, they were just startups, so they couldn't offer someone a career with one company. So instead, they offered a broad base of technical and administrative people, not just top people, but a broad base of people, stock options. And they could do that because of changes that had taken place in the 1970s, the rise of NASDAQ, et cetera. And then the last thing was globalization, which really started in its current form in the 1960s with the semiconductor industry, that almost every semiconductor company that set up in the late 1960s went to Asia to package and assemble semiconductors, which was very important for Asia as getting its a foot in the door of this important growth industry. And that just continued, so that increasingly companies were looking abroad, not just for low-wage labor, because if they could have gone to Africa for the lowest wage labor, but for well-educated, high school or college-educated labor that could do the job. And they found lots and lots of those people in Asia. And that really kicked in after 2000, when the Indian and the Chinese economy really started supplying huge numbers, millions and millions of people who were high school, college-educated, and could do the work of American workers. So you had all those changes taking place, and in each case there was a need for companies to change. So that's actually the starting point. It's at that point we're really still talking about, okay, so what are the companies going to do now to remain innovative? And that's where the trouble begins. And that's where financialization starts kicking in. The old system of career with one company, that was a retain and reinvest system. The companies got their profits and they share them with their employees by keeping them employed, by investing in their skills, and that's how we got a strong middle class. So now you have these changes I just described as rationalization, marketization, and globalization. Nobody could avoid them. They were part of a process of change and global innovation, really. But then the issue was, what were a company going to do? So if they continued to retain and reinvest, they would have upgraded the capabilities of their blue-collar workers. They would have, maybe working with the government, found other sources of employment for older white-collar workers who, after all, had huge amounts of not only education but experience. And we would still have had a strong middle class. But they didn't do that. Instead, increasingly, companies went to what I call downsize and distribute. That is, they would lay off workers and distribute the profits to shareholders in the forms of dividends, and something new for the 1980s, really. It existed before, but as an important phenomenon, stock buybacks. And that turned out to be largely the reaction that companies took until it became systemic. And there were a couple reasons for this. One was economic ideology. The ideology arose within this context of change that it existed among economists that you have to allocate resources through the markets. And basically these large corporations were just a huge market imperfection. And that's the view that was taken both by conservative economists, like people like Milton Friedman and his followers, and liberal economist Samuelson and his followers. And they didn't understand, or they didn't know, or they didn't care about what was going on within these large corporations and how these large corporations had to be governed in order to have retain and reinvest. So whether they knew it or not, they were advocating downsize and distribute, because they were saying, we've got a problem with the economy, we can't compete with the Japanese, we can't compete with the new economy companies, there's globalization. So let's just let the markets reallocate resources, and that was disaster. That's financialization. That ended up being downsize distribute. And then on top of that, coming out, now this came largely out of the Chicago school, but never challenged by the East Coast liberals, the Harvard and MIT, the Princeton, whatever liberals, was the ideology that companies, in fact, should downsize and distribute. It was called maximizing shareholder value. And it was put forward as a theory of value creation, but it's really a theory of value extraction. The amount of money that's coming out of companies through stock buybacks is massive, and it gets bigger all the time if you go decade by decade. In 1997, buybacks surpassed dividends in the U.S. corporate economy as a mode of distributing cash to shareholders. Now, the big difference is you get dividends for holding stock. You get gains from buybacks from selling stock, And you have to time the selling to be related to when the buybacks are being done, or there's too many ups and downs in the stock market otherwise to benefit from that impact. After about 2000, buybacks became systemic. Companies did them year after year. And between 2003 and 2007 for the S&P 500, which we track, buybacks quadrupled in value from about 300 million to 1.2 billion. Of course, the stock market was going up, so some of that's accounted for by higher stock prices, but probably was a huge increase in buybacks. That crashed with the great financial crisis. They stopped doing buybacks. They kept doing dividends. Dividends were rising throughout this period. And then they've been off to the races since then. And for the last decade, 2006 to 2015, we have the data at least right now, buybacks by the S&P 500 companies were about $3.9 trillion. That was 54% of their net income. Another 37% of their net income went to dividends. So there's kind of 9% left over that. A lot of that's parked overseas. So it's a huge amount of money. Often it's more than 100% of the net income of companies. And we dig into a lot of different companies to see what damage buybacks has done, what they aren't doing as a result of doing buybacks, or what they are doing that are not beneficial to us. I mean, one prominent example we use is the drug companies go in and say we need high drug prices to augment our spending on R&D, but companies like Pfizer and Merck and many others do 100% of their net income goes to distributions to shareholders, and often more of it to buybacks than to dividends. So it's become huge. It's not a small part of the economy. I've also, using the Federal Reserve Flow Fund data, which we kind of measured this relative to GDP, so decade by decade. And for the decade 2006 to 2015, relative to GDP, it's about 2.5 times what it was the previous decade, and has been growing as an outflow of money all this time. So what all this money is doing, people are going to work every day. They're creating value through the products they produce. Then the companies are distributing to people who want to sell the shares. Now, among the prime beneficiaries of being able to sell the shares when stock prices are increased through buybacks are the corporate executives who make these decisions. And the work we've done on executive pay, a lot of it's done in the last couple of years on INET grants, shown that for the top 500 highest paid executives in each year from, let's say, 2006 to 2015, when the stock market's up, like in 2015, there was 82% of their pay of average about 32.6 million came from stock options, stock awards. When the stock market's down, their pay is down maybe to 20 million on average, but and the stock-based pay is about 66% of the total. Under any circumstances, it's the stock-based pay that is the most important component of what they're taking home, putting in the bank, and it's incentivizing executives to basically loot the industrial corporation. Now, in the last decade, particularly, they've been assisted in this by the growing power of hedge funds that just love stock buybacks and are going in and saying, do more, lay off people, downsize, distribute, do stock buybacks. That's our money, but we don't hear much about hostile takeovers or hostile raids. They're all in bed together now. And pension funds in particular, but mutual funds as well, are not in the business of timing the market. It's the hedge funds, it's the top executives and the Wall Street bankers who are kind of doing the financial engineering for them, who not only are in that business but have the information or are able to get the information to do this. So they're the ones who are benefiting, and we can see that. You can see the outcomes. What I'm providing as an explanation to the outcomes, and I argue this is actually the most important reason why we are getting a concentration of income at the top, and a loss of middle-class jobs. These are not two separate phenomena. They're integrally related because of the way that corporations are allocating resources and the incentives that we've created and the rules that we've created to allow them to do this.